Joe knows taxes.
Joe knows the market.
Joe knows Social Security.
Joe knows income planning.
Joe knows pickleball? No.
This is Joe Knows Retirement.
In today's podcast episode, we're going to talk about the importance of tax planning for retirees. Now, this is a topic that I've obviously talked a lot about. I've wrote a book on it. We do a ton of tax planning at our firm. We do a lot of tax planning webinars and workshops in our community. It's a topic, in my opinion, that is not talked about enough. It's something that a lot of advisors just don't specialize in. It's something that I would probably think is the biggest need for retirees in retirement. And it's simply because, in my opinion, taxes are the biggest expense you're going to see. I mean, especially if you've done a great job of saving all of these years, you're now forced in a position that if you want to take out money from your investments, you're going to have to pay taxes. So if you've saved a lot in your 401k or your IRA, what happens when you got to take that money out? Well, it counts as income. And like I said, you've got to pay taxes. And so we're seeing a big challenge for retirees because not only are they having to pay taxes on that, but they're also having to pay taxes on their Social Security now, which is something we'll talk about today. Social Security used to not always be taxed, but now it is. And if your income is higher, now you're going to force Social Security to nearly be fully taxable, which can cause retirees to pay even more taxes in retirement. So we often hear the saying of like, I'm not going to be in a higher tax bracket in retirement. And that could be true for some people. But if you've got a larger amount saved up, let's call it $1 million or more, well, you're going to be forced to take out money from your investments starting at age 73 when you're retired, or 75 if you're born in 1960 or after. And my question is what's that going to do to your income? And what is that going to do in addition to Social Security, as I mentioned? And now between the taxes you could be paying on Social Security and the taxes from that RMD, that required minimum distribution, you may be paying about the same amount of taxes in retirement than you are now. And maybe it's a little less or maybe it's a little more. But the thought is that you're not going to be in a significantly lower tax bracket in retirement. Now, if you have not saved as much money, let's say you have $250,000 or less, well, you may be in the lowest tax bracket forever because of the standard deduction. And maybe anything you take out from those investments remains in the standard deduction, which is that tax-free bracket, that 0% bracket. And so you may just not have to pay any taxes at all. And so in your case, you may be in a lower tax bracket. But most people we work for are obviously not in that place. They've done a great job of saving, and now they're in a position where they need the money to live on. And if they take it out, now they've got to pay taxes. So how do we plan for that? And so those are some of the reasons why I think tax planning for retirees is so important. I think it's also important to understand not only our current state of retirees, but also the current state of the economy. And we're obviously have a lot of debt right now. We're $32 trillion in debt. And as most people would think, what do we have to do to help cover that debt? Well, most people would suggest we just stop spending, which I think that would be a wise thing to do. But as you can see, that's probably not going to happen. And if that doesn't happen, what's next? Well, they're probably going to raise taxes or raise things like inflation, which may not be considered a tax. But in my mind, that's a hidden tax because it helps cover up some of that spending. And so that's in my mind why I think tax rates have to go up. And so that's my personal conviction. Most people I ask that question of, do you think taxes are going to go up or down? Most people suggest they're going to go up. And so that's why I believe for retirees, now's the time to start planning. And especially knowing what is going to happen in 2026. So if you haven't been paying attention to this, in 2017, President Trump enacted something called the Tax Cuts and Jobs Act. And what that did was lower taxes from 2017 to 2026. And so during this period of time that we've been in currently, taxes have been on sale. And we're going to have this sale until 2026. So we've got a couple more years to take advantage of this. But the question becomes, what are tax rates going to be? Well, for most people, when we ran this analysis, their taxes will increase by about 20%. They'll have to pay about 20% more. Meaning if you're paying $10,000 in taxes today, you're going to have to pay about $12,000 in taxes in just a few short years. If you have the same situation, the same income, the only difference is you're seeing a different tax code. And so that's why we would suggest, hey, we better start planning now because retirees are going to be facing higher taxes here in the near future. But then my question becomes of what do you think taxes are going to be in the far future? Or not even the far future, but after 2026? What are they going to be in 5 years, 10 years, 15 years, 20 years? And obviously, I'm not here to tell you what that they're going to do because I don't know. The tax code's written in pencil is something I say all the time. But if we have to take a guess, most people would probably suggest they're going to be higher. And the reason why I personally take that guess is for a couple reasons. One is that tax rates are among the lowest that we've seen in history, not the lowest, but among the lowest that we've seen historically. And if you look at our current debt crisis, if you look at, tax rates have been higher this in the future, or they've been higher than this in the past, where do you think they're going to go in the future? And so because of that, I don't think we'll ever see lower tax rates in your lifetime, in my lifetime. And so everything I'm personally doing for myself and what we do for clients is how do we prepare for tax rates being higher in the future? And maybe they aren't higher in the future. And if so, great. But I can guarantee you, I should watch saying guarantee, my compliance person is going to get on me here, but I can highly suggest that you're going to be facing higher tax brackets than what you're seeing now at some point in the future. And so what we try to advise our clients of is let's try to make sure we have a balance here, make sure we're planning for taxes going down, planning for taxes going up, so that we have a very balanced financial plan, a very balanced tax plan, and so that we can be tax smart and pay our fair share of taxes, but not more. So that's something that I talk about in the book I've wrote, which is called I Hate Taxes, is all about how do you lower your taxes, but own your retirement. And owning your retirement means take action on the tax planning. And that's something that we see a lot of retirees where maybe they're working with a financial planner, but they're only doing investment management. And so you may be missing the other pieces of the pie if you're not being proactive, if you're not taking action. And so if your current advisor does not do tax planning, I'd highly suggest you get a second opinion to make sure you're getting what's done right. Because like I said, if taxes are your big expense in your retirement and you haven't planned for it and taxes are going up, you could be missing some opportunities there. So those are something that we would make sure we advise people on, is just make sure you're on top of this. The other reason why the importance of tax planning for retirees is so important now is because, as I shared earlier, most people have their money in 401ks and IRAs. So I usually show a fun chart that shows the difference between tax-deferred and tax-free. And tax-deferred, it's, hey, you haven't paid taxes on that money yet, right? That's that 401k, that's that IRA that you save money into up front. And then when you retire, when you take money out, you've got to pay taxes. So let's say you put $10,000 in there up front. You're probably feeling pretty good and you're excited because you got a tax savings today. But if that money grows over time and now it's $100,000 and you say, I need $100,000, well, now you have to pay taxes on that full $100,000. So you saved on $10,000, but you paid it on $100,000. And I often joke, is that a good deal? And so that's how that tax-deferred bucket works. And so I ultimately think of it as, hey, Uncle Sam's your partner with that investment, and he's going to be there with you until you either force him out or he forces you to take it out at RMD age, which are required minimum distributions, which we'll talk about here in a second. And so if that's the case, we've got to get him out one way or another, or he's going to end up getting what he wants at whatever percentage tax rate that he wants to make it. So we've got to decide, do we want to pay it now or do we want to pay it later, right? And an alternative way of investing from a tax standpoint is what we call a Roth IRA or a Roth 401k, and we consider those our tax-free type of vehicles. In that tax-free vehicle, you put your $10,000 in up front, and you don't necessarily like it as much because you don't get the tax savings. But if this money grows to $100,000, like we just mentioned in our example prior, well, now when you take out $100,000, you don't pay any tax. You don't have to show the government any income for that, and that's all tax-free. And so in the Roth, I often ask people, if you had a magic wand, where do you want your money? Well, obviously everyone says in the Roth because that sounds like the best deal, right? And I would say it probably makes sense for a lot of people to have some money in the Roth, and maybe more than some money, maybe a lot of money in the Roth. It all depends on your situation. But what we see is that most people just have their money in 401ks and IRAs. And we see, there's stats out there that show that $30 trillion are in the tax-deferred bucket. In the tax-free bucket we just talked about, there's less than $1 trillion. And so if you're looking at that, there's 30 times more money in tax-deferred. But everyone wants their money in tax-free. So why is there this disconnect? And in my opinion, the biggest disconnect is because of education. Not enough people know how to get their money out of the tax-deferred in smart ways. And like I said, tax-free, the tax sale has been going on for the last 5 years, since 2017. It's Tax Cuts and Jobs Act. So you've technically had an opportunity where you could start taking advantage of this idea of moving money from tax deferred to tax free, which is called a Roth conversion. So if you haven't been doing strategies like that, or you haven't been looking to see if that makes sense, that's why I'm saying, hey, this is so important today, is because these are strategies that a lot of our clients are taking advantage of to take advantage of this tax sale. So they're paying lower taxes now, so they don't have to pay higher taxes in the future. So if that's you and you have a lot of money in tax deferred, I would highly encourage you to look at tax planning further, because you're the one in my mind who's going to be impacted the most by taxes in retirement. Like I said earlier, a lot of our clients do not end up paying less taxes in retirement if they don't make any changes. If they don't make any changes, they're going to be paying way more in taxes. And it's because of that RMD that I mentioned earlier. So let's talk a little bit further about that required minimum distribution. So let's just use the example. If you have $1 million and you're 73, well, you're going to have to be required to take out about 4% from that tax deferred vehicle there. And if you do the numbers there, that's about $40,000 you have to take out. And let's say you have $2 million. Well, now 4% is about $80,000 that you have to take out. And my question is do you think that's going to increase your tax bracket? Do you think that's going to increase your taxes you're going to have to pay on Social Security? Is that going to increase, your Medicare premiums if your RMD is going to be even higher than that in the future? These are all things that we have to consider when building out a tax plan and understanding, should we look to find ways to reduce that RMD in the future so we're not forced to take out as much money? And I often joke, is it ever a good thing when the government forces us to do something? It's a funny joke, but it's probably not a good thing, is it? It's probably not a good thing that they can just make a rule to say you have to take out money at this year, no matter if you like to do it or not. I don't think that empowers us very much. I don't think that gives us much control. And so that's something we want to educate people on as well, is that, like I said, own your retirement. So those are some of the considerations for that RMD. Understand, like I said earlier, if you don't have as much saved, let's call it $250,000 or less, your RMD may not be that significant. You may not have to worry about tax planning as much if that's you. But if you start to have more than that, then this stuff makes a lot of sense to start planning for. And you want to make sure you've got some of those ducks in a row when you get to that point. The other thing to understand with RMDs is, and why I think it's such an importance to do tax planning for retirees also, is RMDs increase over time. So you have to take out about 4% at 73, but by the time you're 90, that number could go up to 8 or 9% that you're required to take out, which means what to your income? Well, that means you have to take out more, which means your income is going to rise, which means your tax rate is going to rise, and you're going to have to pay more taxes. And so this is something you've got to be starting to plan for now. And if you don't, we call it a retirement tax time bomb. It could get worse and worse as time goes on. And so that's the importance of planning for that RMD there. So I mentioned earlier that Social Security could be taxed, right? So I want to make it very clear that Social Security used to not be taxed. So if you go back before 1980, anyone who received that, let's call it a $3,000 a month check from Social Security, they didn't have to pay taxes on it. It was tax-free. And so you're probably thinking, hey, that's a pretty good deal, right? I like the money that I paid hard for, the money I've already paid in Social Security. I like getting that tax-free. Well, now the money you paid in Social Security, when you receive that $3,000 check, you may not get all of that $3,000. Some of that $3,000 may go to Uncle Sam to pay the taxes on that benefit. And you may ask, why did they change that? Why did they change from Social Security being tax-free to now some people have to pay taxes on it? And as you know it, Social Security is in trouble, right? I mean, I think Social Security Administration's website says 2033, it's running out. And I don't personally think Social Security is going to go away for the baby boomers, but it is in trouble. And so what that means is they have to make changes to the plan to keep it in place for a longer period of time. And one of those changes that they made prior is changing the age of changing the amount of tax that you have to pay on your benefit. So right now you're only required to pay up to 85% of your Social Security benefit could be taxable as income, and then it would be taxable at your income rate. So to understand that, you don't have to pay an 85% tax rate. It just means that if you have $30,000 a year from Social Security, 85% of that $30,000 would be counted as income, which would then be counted at 12% or 22% or 24% based on what your income tax or your income rate was, your federal income tax rate was for that. So also understand here in Ohio, Social Security, we don't have to pay tax on our state tax on Social Security here. So in that sense, it's tax-free still. That could change in the future. I don't hear anything that's going to change, but just understand that's how it works. So what we're trying to advise most people on that we work with, though, is that Social Security could still be tax-free here federally. from a federal standpoint, you could get Social Security tax-free if you do the right planning and you start acting now. So we have a lot of our clients in this position where they don't pay any tax on their Social Security benefit that they receive every month. And the reason why is because we've been able to be tax smart, is what I've called it. And we've been able to show that they have a lower income in retirement. And I know what you're thinking. I don't want to show a lower income in retirement because I want to enjoy what I've worked hard for. Well, remember that Roth concept I talked about earlier? You can take money out of a Roth and still live on it and still enjoy it, but you don't have to tell Uncle Sam, and he doesn't have to count it towards the tax limits for that year. And that's a way that you can reduce your income in retirement, but still live on that $100,000 that you want to, and still get that full amount from your Social Security benefit. So that's something we always want to advise people of. So you need to know where that sweet spot is, where Social Security is tax-free before it starts to become taxable. And this is something you also have to look out for. It's called a Social Security tax torpedo. I've written a Kiplinger article. I got featured in Kiplinger on this topic. And basically what it means is that you could pay a 40 to 50% tax rate on Social Security if your income goes over that particular point where you're forcing Social Security now to become nearly fully taxable and you're causing yourself to be in a higher tax bracket. Those two combined can mean you pay a 40 to 50% tax if you take out additional money from that point. So I'll give you an example. We had a client take out $20,000 in retirement, or at least wanted to take out $20,000. We looked at their tax plan, and if they took $20,000 out of their IRA, they would have had to pay a 40% tax on that $20,000. And that means that they would get $12,000, but Uncle Sam would get $8,000. And I don't know about you, but I don't think that's a good deal. And so what we actually did is we did not take the $20,000 out of their IRA. Now, we weren't mean and we didn't tell them you can't take out any money. That's not who we are. We want people to enjoy the retirement, especially if they saved enough to get there. So what we told them is, hey, we've got this Roth here. Let's take this $20,000 out of the Roth, and you just saved $8,000 in taxes. And then we can look to take out from the IRA next year when your income is lower, or maybe tax rates go down and we can use it then. And so you can see how having this flexibility with tax planning and having a balance of that tax-deferred investment we talked about and tax-free can help us as we plan in retirement, and especially when planning for Social Security taxes. So just be aware of that Social Security tax torpedo. And what we try to advise our clients is let's either keep them in that 0% Social Security tax area, or let's keep them in front of that torpedo that I just mentioned and keep their income low enough to stay in one of those two areas, depending on their situation. Now, if you have a pension, only 20% of people have a pension nowadays, but if you have a pension, then this planning becomes even more important for you because you're already starting yourself further along and forcing your income to be higher. That plus Social Security plus any investment withdrawals can typically lead to a lot of taxes that you may have to pay in retirement. So a pension is an awesome thing, but just make sure that we're planning for that if that's you. Another thing to worry about and why tax planning is so important for retirees, and I think I've kind of summed it up, but I want to just make sure I make it really particular here. Your taxes in retirement are very different. I mean, think about it. When you're working, you typically only have to worry about, federal income taxes, state taxes, local taxes, payroll taxes. There's not a lot of additional taxes like having to pay for your taxes on your Social Security benefit potentially. Or Medicare premiums is another one that we'll talk about. So Medicare premiums are means-based, which means that the more money you make, the more you have to pay for that Medicare premium. You may get the same coverage as a guy down the street who doesn't have anything, but you're going to have to pay significantly more. And so that's something we're also advising our clients of let's make sure we keep our income lower in retirement so we're not having to pay more for health care because that's how Medicare operates. So you don't have to worry about that while you're working. You also have to be aware of, the investment withdrawals outside of retirement accounts. So let's say you have a capital gain type of investment, a non-qualified investment where you've paid capital gains tax on it over the years, but maybe you haven't paid capital gains tax on all of the growth that you've seen. So when you take out money from that, what happens? Well, now you have to pay capital gains tax. And how does that interfere with the other taxes that you're going to have to pay? And how can we strategically get some of those capital gains at 0% versus 15% or 20%? And so you want to be very tax smart when it comes to capital gains planning as well. So those are some of the considerations of why we feel that tax planning is so important specifically for retirees. And that's where we specialize in. Most of our clients, I think it's 95% of our clients are between the ages of like 55 to 70. And so because of that, we're able to really focus in on this niche of retirees, since your tax situation is much different than someone who is younger. And so that's the concept there. The other thing I'll end with, it's kind of a morbid topic, but it's important, is just to understand, obviously, when you reach retirement, you're not going to live forever. And so we want to make sure we're planned, especially if you're married, because if you're married and one spouse passes away, your taxes are going to change dramatically. And so we want to prepare for this. It's called the widow's penalty. And this simply says that if you're married filing jointly taxes, if one spouse passes away, you no longer have that benefit. You have it for that year, but you don't have it moving forward. And so your taxes will go from there to single. And if you know anything about the tax brackets, your taxes are going to pretty much double, nearly double if that happens, because you're going to be forced to pay more taxes if your income is similar to what it was. Even if your income is a little lower, we've done an analysis before to show that, hey, if you pass away, yes, one of the Social Securities will drop off. The single spouse will only get one of the two. And so you may have a lower income, but you still may be paying more in taxes because your standard deduction gets cut in half, but also the tax brackets get cut in half as well. And so we got to start planning for that widow's penalty now, if that's your goal, to make sure your spouse is taken care of and making sure that they're not paying more taxes than they need to. And so if we can proactively plan now, we can put your spouse in a better position so they're not having to pay as much taxes moving forward. So to wrap up here on this podcast today, I just hope this was helpful to explain the importance of tax planning for retirees. Again, I would suggest any retiree, especially if you've saved a lot up in your tax-deferred investments, this is a topic you're not going to want to miss. Just make sure you've got a plan in place. There's a tax code there for a reason. Uncle Sam gives us a tax code to make sure we see what loopholes, what opportunities are in that tax code. The only thing is that most people don't read that tax code. And so you have to be proactive, you have to read it, you have to do the work, and more importantly, find someone you trust who can help do this for you so you're paying the least amount of taxes over your retirement. Pay your fair share, but not a penny more.
Since we do not know your specific situation, none of this information can serve as tax, legal, insurance, or financial advice and may be outdated or inaccurate. The information comes from sources believed to be reliable but cannot be guaranteed. This content is prepared for educational purposes only. If you need advice, please contact a qualified CPA, attorney, insurance agent, financial advisor, or the appropriate professional for the subject you would like help with. Peak Retirement Planning, Inc. is an Ohio-based registered investment advisor and able to offer advisory services in Ohio and in other states where registered or exempt from registration.